Hello, everybody. Welcome to our August 9th edition of the Governance and Risk meeting with Stephen Becker. We're back on schedule after a brief interruption last week for a special edition of this call where we discussed the stability fee raise. That was a great episode, so if you have an opportunity, it's worth checking out on our YouTube channel. But today we're back to business. There's been a lot of activity in the community, and I think that I'll let Stephen talk about the agenda in a second, but I think we're going to focus on some catch up with some of the great questions that we've been getting recently. I'm just going to jump right in because we don't really need me to discuss what's about to happen. Stephen, you'd like to introduce yourself and maybe get us started?
Not a problem. So my name is Stephen Becker. I'm head of risk at Maker. I essentially try and look after the collateral portfolio and its management to keep the integrity of the process and stability of the coin in check. And today, the first thing I would like to do is recap from the previous call, and I am talking about the stability fee call. So if anybody has any questions around that, we can also dive into it as much as possible. Then afterwards, we can go into the second paper or the second article that was submitted that looked specifically at the risks inherent in supply and DAI. And what I'll do is spend some time going through what those risks are, and we can maybe even start a bit of a discussion on each one of them. And then probably more at the end of the session, have a look at one risk in particular, which will start the series of diving deeper into each of these risks. And that will be the qualitative risk, how to take a sort of qualitative assessment of each collateral type and view it in terms of its longevity from a fundamental point of view. Then afterwards, we'll maybe take a few more questions, and that should be the extent of it. I don't think, we seem to get a good dialogue going. So I'm hoping we can cover all these topics during the session. So,
sounds good. Stephen, before we jump in too far, your mic is a little muddy today. Are you going through your AirPods?
Give me a second. Let me go get a change of scenery. I'll change my earphones.
Okay, cheers. Sorry about that.
No, it's fine.
And also, as Jess isn't going to be joining us, I don't think today, I might be a little slow on noticing questions in the chat, but I'll get there when I possibly can. We have a lot of people that are brave enough to be on camera today, which is great. If anyone has any questions, please jump in. Feel free to interrupt. If it's, all of the input is great. And that includes people that actually work at MakerDAO, because I know that not everyone knows all this stuff, so please don't be shy about asking questions.
Testing, is that better?
Yeah, that's perfect. Actually.
Okay, super.
Cool.
So I got my strange painting in the background and my earphones on, so I'm good to go.
The other ones are more elegant, but these ones sound better.
Okay, so let's start with the recap then, shall we, Richard?
Sounds great.
Okay, so last week we had a look at what the stability fee is. Obviously, we spoke about the fact that it was raised, but more importantly, we had a look at what it actually is in terms of an interest rate, that it actually is comprised of a couple of components that look after not only the purchasing power that needs to be compensated for, the underlying credit risk premium that is basically covering the insurance that MKR token holders have baked into the system, and then a third factor, which is an operational risk premium, which pays for the operation but also acts, more importantly, as a policy tool. And those three factors combine nicely into what we call a stability fee. It's not exactly an interest rate, because an interest rate generally has a reference to a duration or a tenor, and consequently it would have a liquidity preference premium built in as well. We don't have that. So as a consequence, those are the three factors that make up a stability fee. Now, in terms of why we raised it, it was more a case of making it more comparable to the fiat-based short-term interest rates, so that
we don't have this overabundance of supply due to cheap financing. You know, a lot of folks have commented on the quadruple effect of the interest rate hike, but in essence, it's not really seen as you shouldn't see it really as a quadruple effect, because it should be benchmarked against, you know, other sort of financing that you have in this area.
So can you explain quadruple effect?
When you have a look at the Fed and they move up their policy rate from, let's say, 25 basis points to 50 basis points, the fact that it's doubled is immense. It's huge, because that leverage is already built into the economy. That sensitivity is built into the duration of and so forth. So having such a huge move in interest rates really affects you pretty much right to the bottom line. Where here we're starting from very, very cheap financing. So what we need to do is first get to a point where it is actually comparative to the type of financing that you can get elsewhere. And then from there, it should be a case of, well, you know, if we went from 2.5% to 5%, that would be kind of similar. That would have the sort of multiplier effect that really should concern folks. But we're actually now at the point where we are more comparative to the short-term LIBOR, USD LIBOR interest rate term structure, which is still way below what you'd get as a retail investor. So there's still the ability to be competitive there. And I think you can tell, you know, discount the little route that we've had in the market, discount that, you can see that the linear build in the supply of DAI has tapered off a little bit, but hasn't actually stopped altogether. The other thing we mentioned about the stability fee is that it is a policy tool. Now, a policy tool is extraordinarily important because your underlying governing dynamics looks after the stability of the token and integrity of the system. But in order for governing dynamics to work appropriately, you need to have a certain amount of breadth and depth of economic activity on the blockchain. And because we're in the sort of beginning periods of this build in economic activity and economic growth, your governing dynamics are not going to work as continuously or as fluidly as you wish them to. Consequently, if you actually extend that, you would then naturally realize that any other algorithmic attempt to fashion such a coin on the blockchain will also require the breadth and depth of economy. And if it's missing, then there's a very much higher chance, or it's highly probable that it will not work. So you do need to have a collateralized component that has an underlying governing dynamic, but where that needs a stopgap, you need to have a little bit of intervention, and that's where policy tool comes in. And that policy tool is quite essential. So that's pretty much is a recap of the previous meeting about stability fee. So I'm going to pause there for a moment to see if there's any question, comments, or otherwise.
No, I'm not seeing
anything. Okay, cool beans. So we can move on to, so the second article I submitted started looking at the inherent risks of supplying DAI through CDPs. Now this is interesting because you got to look back and say, well, we all know how it works. We all know, what is required in order to, pledge your collateral, draw out your DAI and use it. But essentially, what are we covering in there? What are the aspects that we need to look at and be very vigilant of and very cognizant of whilst we use our CDPs and obviously transact in DAI? And the first one is quite simply a case of saying, well, if we're going to pledge collateral, then what is the most important part of this collateral that we're pledging that will concern us? And that, in short, is effectively the volatility. The reason being is pretty simple. As I sort of pointed out in the article, I always like to use gold, because gold has got this firm sense of understanding in everyone's head, but yet it is actually quite an esoteric and abstract asset, especially when it comes to money supply, because it's treated completely differently in the traditional world. But in order to collateralize anything, very much like your mortgage that you take out on a house, the bank will give you financing but your house is placed as the obvious collateral behind it. And if you default, they usually have enough equity in it to sell and recover any losses. So the same aspect is used here. If you do pledge collateral, you have to worry about the fact that a certain amount of recourse is necessary. If your loan fails, how does one go about satisfying recourse? And the way that we've set it up is that recourse is satisfied in the secondary market. Now, I'm emphasizing this because you can actually have recourse in other avenues, and those are quite interesting avenues, and we can explore them at maybe at a later time. But for now, the secondary market price discovery is where we find recourse with these assets. That means we need to consider how they traded, which means we need to consider everything about them, and the most important aspect is the volatility. Because, simply put, the more volatile the asset is, the more collateral you will require in order to ensure the stability of the loan that you take out against it. So I'm going to stop there for a second. Any comments there? Because this is generally where folks start thinking about it in terms of how you see an asset traded on an exchange. What do you need to consider? Volatility is just the ultimate manifestation of price movement. But if you think about it a little clearer, you realize that it is attached to the type of exchange that you're involved with. It is attached to the depth of the bid and ask stack that you're looking at, and essentially is also attached to a distribution of participants in that particular market, all the way through to long-term investors. This concept of, yep.
Sorry, I think I have a question. So when you're calculating, when you're trying to measure the volatility of an asset, is that volatility measured over time? Is there a specific time period that you guys look at? So
yes. So generally what you want to do is you create a horizon for yourself, and the horizon is generally 1 day.
Okay. You
want to say, what is your exposure over 1 day? And then there's this, depending if you want to have a tractable model, you might be able to even, you may be even able to increase that time period to 2-3 days, whatever suits your horizon. And that is a very important question, because when you consider collateral, you've got to consider it in the light of how quickly will you be able to actually liquidate this collateral. And so there is a volatility adjustment, and that volatility adjustment is liquidity constraint. So not only do you have to think about, I have, let's say I've got $3,000 worth of ETH to sell on the market. How quickly will I be able to sell that? Well, considering the volume on a daily basis, $3,000 worth of ETH is pretty easy. You can quite easily do that. But if you have a look at other assets that do not have such high volume and such uniform distribution of trading, you might find that $3,000 worth of that asset will have a meaningful impact on the price. And so it will go against you. So the volatility will not be able to encapsulate that potential downward move in the price as well. So that's why it's also very important. I say volatility, but what folks must think about is where this volatility comes from, all the way back to literally having in your mind's eye the bid-ask stack and imagining how trade works, imagine how price discovery works, and basically figuring out what is representative value and how do you actually calculate volatility from that representative value. The notion is simple at first, but the more you delve into it, the more it becomes a little bit more interesting. So that's volatility. Now, the one aspect that is really interesting is when you go to these large investment managers and ask them, what is your investment process? I can tell you that as far as the due diligence is concerned on an investment manager, that process is absolutely key. It is one of the fundamental premises on which you base your decision if you want to place money with them. So what is so important about this is that they look at an investment, and this is very similar to the way we look at a collateral type. They look at an investment from a fundamental point of view. They look at the internal workings, they look at the management, they look at the market, they look at the competitive behavior, the placement, and so on and so forth. They need to have a fundamental understanding of where this organization is placed in the economic system. And the reason that is important is because on the other side, and this is what we don't do, they do a financial analysis on that particular company or asset, and they will derive a value. And that value for them is going to be more or less the price they're willing to pay. But the understanding that they get from the fundamental or qualitative aspects of that organization will determine the possibility of that value moving around. You might find that some guys will start out with one product in an organization, which is fine. It's usually what happens with startups. But as you move along, you might find that product doesn't get traction, and they may pivot. They may pivot to another product. Or that product may get traction, and they decide to include other products. And as that happens, so that organization matures, and so the fundamentals of that organization either improves or becomes more variable. So it's extraordinarily important that we get at least a snapshot idea of the qualitative behavior behind an organization that has issued tokens.
Can I jump in for a second?
Yeah, sure.
How challenging is it to make a quantitative, or sorry, how challenging is it to get that kind of insight in the crypto space? Because frequently we're dealing with businesses that, to put it, kindly, are run by people that are new to the business world. You're not always going to find strict adherence to best practices. There's not going to be an open book that can be audited. So how do you come up with those kind of evaluations in this space? Is that going to be a bit of a challenge? Or?
Very difficultly.
Yeah.
When we dive into this sort of qualitative risk assessment, it's actually an exercise of trying to standardize a way of looking at things. Because if you just take a lot of traditional tools and bring them into the space, you need to discern a decent categorization of tokens. Is it for utility? Is it a stock type? Is it backed by anything? What is its purpose? We are in such a unique area where the not only the capital structure, but the actual structure of the organization can be tokenized. So you will have different representations of that particular organization through the tokens it issues. These things are immensely complicated for now. And the reason they're complicated is not so much information, and we still got to figure it out. There's too little information. So there's a lot we have to abstract and hope that as we move forward and as the economy grows and develops on the blockchain, so it will flesh out all the details for us. And we'll either find that our abstractions were way off or that we were pretty much spot on.
Is there an opportunity, so we can research these organizations from the outside looking in, but is there a precedent or an opportunity to just simply get in contact with an organization and say, like, hey, we're thinking of evaluating you as an asset class. Can you fill out this 50-page questionnaire or something? Is that done?
Essentially, that's what we'd like to do, right? But that is, it's really a little bit too new to understand if folks would even think about doing that. On the one side, you have a lot of folks coming to us because they can see clearly that being part of the Maker system will benefit their organization immensely, especially from the financing point of view, from the transactional point of view. Being involved on the blockchain requires transactions. Those transactions require a stable store of value, and this is what we produce. So we are facilitating this growth with them. They need us, we need them. They will come to us if there's a realization, but there are some folks out there that might be just really big, and they go, well, we're doing fine. All of us are sitting very pretty in terms of wealth, and things are going along smoothly. Thank you very much. We don't need to be a part of your system yet. So we have to, unfortunately, review them from the outside. Mm-hmm. And when we review them from the outside, it will impact their debt ceiling. It will impact what we can be exposed to. And what we hope is that if investors in those particular tokens come on board and actually use them as collateral type, there will be enough I wouldn't say pressure, but there'll be enough of an attention put onto this space to say, guys, maybe you should consider talking to Maker and let them have a thorough review of where you are so the debt ceiling can be increased. It's just it's a very organic process. A lot of this is actually is organic, but I'm of the opinion that you have to cast your mind forward, 10 years and think about the structure that might fulfill the requirements in 10 years' time, and then sort of reverse engineer and say, well, what do we need now? What do we need to abstract now?
Okay, that makes sense. Thanks.
Okay, there's maybe some questions.
Well, yeah, we did. Ashley has a follow-up, and Ashley, you have access to a webcam. You want to jump in and out?
Yes. Hey, guys. How's it going? I was just wondering, as kind of a follow-on to Rich's comments, Stephen, if you have any thoughts on, obviously this is like supremely difficult to judge, but on what are some of the qualitative things that you're going to look for in some of the newer projects that want to come on as collateral types, i.e., what the status of the founders is, or what the, if they have a presence of other well-known investors that have, kind of spoken out for them, like what kinds of things will you be looking for to make yourself feel more comfortable?
Okay, it's actually, that's pretty easy. What I've done is I've abstracted it to 5 points. The first one is looking at the team, as you pointed out, the core team and advisors, because it is, to a certain extent, obvious that advisors are investors as well. To the extent that we can communicate with these organizations, find out who's supporting them, even the more better. The second one is obviously the community, which is extraordinarily important. Trying to get a sense of the sentiments in the community about the project is vital, because it's not just a representation of what the feeling is for that project, but it's also a representation of the distribution in the community about the feeling for that project. It does represent an inherent value that we need to consider. So the community is a very important aspect. It's almost similar to gauging shareholder sentiment in a large organization, and get a sense of, are folks using this share for merely speculative purposes? Is there a trading influence, or is there long-term prospect that people have staked and are invested in for the long term? Then the third one is technology, security and completeness review, and obviously there's a market and competitiveness review, a simple SWOT analysis, and then most important is also the business models, looking at the structures, looking at not just from a legal point of view, but also in terms of understanding what rights are given to the individual. So those are the 5 broader abstract points, but essentially each one of those points can be broken down into another 4 or 5 points. Only to an extent which will give us a snapshot for now, because as you know, Ashley, to do a proper due diligence, it requires a lot of paperwork and a lot of detail, and most of the time you cross a fine line into private information very quickly. So what we need to do from the outset is create a broader perspective and outline of understanding what we're looking at. There are actually a lot of companies out there that it's not going to be terribly difficult to get different points of view on a particular token or particular organization underlying the token.
So I assume that the fees and the debt ceiling, those would sort of be dependent on the availability of information about the qualitative assessment. So if the organization is transparent, there's lots of history, we can do the due diligence, then potentially there'll be a higher debt ceiling than there would be otherwise. Is that correct? Yes.
So basically the way it works is that these risk numbers are calculated without the qualitative assessment being considered, and you come out with a set of numbers. Those numbers are then adjusted based on what the qualitative assessment is. And those qualitative assessments will obviously depend on a lot of things, including the amount forthcoming. strictly speaking, the amount of information that we require isn't really so much that it actually delves, deep into the private aspects of an organization. It really is based on public-facing information, just like a public investor would assess a company, that look at their financials, look at their press reports, look at the sentiment. The same principle. We do it from the outside. But if we do manage to get something that is a little bit more on the private side, there's going to be obviously a new format that is involved, because there's going to be certain structures behind that and certain outsourcing, because we assure as heck don't want to be the people divulging any private information. So there's actually a sub-industry just around that. I've already seen that it's growing, assessment of coins, at least from the ICO point of view, in terms of it being investment. But I haven't really seen a sort of an investment, a strong investment-based one where coins are actually assessed appropriately with a valuation. I know they're out there. I just haven't seen them yet. I probably would expect that Ashley knows a few, where I don't. But that is the aspect of the the qualitative component, is really trying to go from zero to a sense. I'm not going from zero to a complete knowledge base about everything to do with the organization. It's just to get that sense, to increase the confidence, to know what you're dealing with.
So I guess that makes sense then. So the due diligence process isn't a matter of looking at every nook and cranny and turning over every rock. It's about getting enough of a sense that this organization has met the standard of competence that allows us to feel confident that in the next 6 months they're not going to completely self-destruct, kind of idea.
Yes. I mean, the idea here is to make sure that there isn't this strategic bias, which is very natural, especially in the investment world. If you find that something isn't working for you, you start pivoting elsewhere. And it is great to have that in terms of being able to adapt. But unfortunately, from an investor's perspective, you are in it for a certain profile. And if you change that profile, it is a risk. And that risk needs to be captured. And we try as much as possible to capture that in a qualitative assessment. It's not all encompassing, but it just hopefully gives us that increase in confidence that we need, that we know what we're dealing with.
Okay. Yeah, that sounds interesting. And it sort of intersects with a question that Ayn Rand asked before he had to leave. So I'm going to read that out to you. He says, please, can you give me an idea how far you think different risk teams will diverge in their assessments? For example, if two risk teams evaluate the risk of token X on a scale of 10, one team comes up with a rating of 5. Is the expectation that most of the teams will have closely aligned ratings, or will there be outliers? And I guess the next question would be, how do we address those if that happens?
Well, that also is, well, firstly, I don't know if the teams will be aligned or not. I don't know. That is the whole reasoning behind having these different teams, is that the more orthogonal point of views you can have in the risk function, the more your confidence will increase that you've covered all risks in the actual function. So consequently, you will have differences. Importantly, you need to have a certain critical mass of risk teams in order to get a weighted average that is representative of the whole. In the beginning, you might have 1 or 2. We need to figure out what to do with that. It may simply be a case of averaging. It may be simply a case of taking some sort of median. I don't know. It really needs to develop organically. But as far as different perspectives are concerned, it is actually welcomed. Mm-hmm. We need different perspectives because everyone needs to be a red team for everyone else.
And over time, you mentioned before that we'll be looking at the accuracy of previous risk assessments and assigning different teams weightings based on that performance. Yeah. Is that true?
That's correct.
So over time, we'll have a better sense of whether Team A is better than Team B, or should have a higher influence on the final outcome.
Yeah, you'll find that those measurements aren't as refined as one would hope. It's not like someone sitting at a rating of 7 and someone's going to be 7.1. It's either going to be like 7 or 8. And it will be very clear when that happens, because the back test testing and the out-of-sample testing will be very self-evident. This is not going to be, I don't want this thing to be up for interpretation. It just literally is a case of, there were a couple of hiccups in the time series. You guys picked up 2. You guys only picked up 1. In terms of the distributional characteristic and the statistical characteristics of these, you both are pretty fine. You know, you both aren't wrong or equally wrong. So you both stay at 7, even though one may have only picked up 1 versus 2. Yeah, so that's the qualitative component. And the next one, if there aren't any other questions with respect to that, is the, where am I? Oh, there we go. Is liquidity risk, which I touched on previously with respect to volatility. Liquidity risk is literally the most apparent in any situation. From an investment bank to a mutual fund to where we sit right now, liquidity risk is essential. In fact, just to give you a sense of how important liquidity risk is, the real reason high-frequency funds and high-frequency traders are around is because they are the de facto next-generation market makers. They literally provide and understand liquidity down to a granular level that not many people can see, and that's where they operate. Liquidity risk is extraordinarily important because it is, in essence, the definition of the trading profile for that particular asset. And the more you get to understand that, the more you understand how price discovery works, the more you understand how it's going to influence the value that you will get from the collateral if you are required to liquidate it. So again, the simple component is you have so much, you have $3,000 of ETH, you want to get rid of it tomorrow, not a problem. I mean, ETH is trading, billions a day. But if you've got $3,000 worth of token ABC and it's only trading $9,000 a day, well, $3,000 is going to move the market against you. So you got to be cognizant of that, and you have to break it up into smaller pieces. So there's this balance between time and cost. If you take more time to liquidate your holdings, then you're going to be exposed to the natural risks in the market. But if you try and reduce that time and sell off your assets quickly, you are going to be exposed to costs, more costs. And those costs not only going to be from a transactional point of view, but from the impact that you'll have on the price, which will obviously be against you as well. So liquidity risk is incredibly important. Shall I pause there? Are there any sort of social media questions that you want to address at this point?
Well, yeah, we have a lot of them, but I'm kind of hesitant to interrupt the flow.
Okay.
Do you want to? We could spend maybe the tail end of the meeting and just run through questions as we have them, or do you want to sort of mix things up a bit?
I think mix things up a bit because I think there may be some questions that are related to what we have previously spoken about, and there's some questions that might preempt what we're about to speak about as well. So it may bring some dialogue into.
Okay. Well, we have a series of amazing questions from NK Pine that I could go through. I'm not entirely sure I understand the questions myself, but they sound really interesting, so I'm happy to read them out. The first one that I'm looking at here is, he says, with respect to the exposure, liquidity, and volatility risks, if the market for a particular collateral type significantly contracts, reducing market capitalization, reducing liquidity, increasing volatility, following its institution into the system, what mechanisms are available to tighten the risk parameters post-release after it's been accepted? Yes, he follows up, would this require the governance process to accept updated proposals, or is there a more dynamic mechanism available?
So well, firstly, it's an excellent question, because there's this notion that once the risk parameters are in place, especially the debt ceiling, there's this notion that things will always grow, and we know that if you expect things to grow and always to be growing, 2007, 2008 credit crisis comes to mind. You don't do that. You do need to have the ability to contract especially the debt ceiling. In approving a risk team, you have approved their risk construct, and that risk construct will be based on a certain period of data at any one point in time. And if that data that is used creates these values that show that, for instance, the debt ceiling needs to come down, then in the next executive vote, it will be placed in there. It will be placed in there to adjust appropriately. If it is tantamount to creating an existential risk, then you probably find that it will be an emergency vote where it will be put in immediately.
But it's interesting. I don't think we've ever spoken about emergency votes before.
Yeah.
Is this one of the things that we know that we're going to do, but we don't have a lot of clarity on what that looks like, or is there some clarity you can let us?
Well, there's some clarity. There is an idea where you can actually have that adjust because it is part of the risk structure. You don't need a vote to pass it, right? But essentially, it depends on how important this is. If it is absolutely vital and it's obviously part of the risk without the need for a vote. But if it is not essential, I think it is just part and parcel of being polite in terms of showing how changes can move up and down against a particular asset if that sense of emergency or risk is not there.
Mm-hmm.
I mean, for instance, you might find a token's debt ceiling is 10 million, and then the next quarter it might be 8.75 million. It's not a massive change. It's not going from 10 to 1. So therefore, it's something that you can maybe introduce on a more periodic basis than on an intermittent one.
So is part of the, I guess, part of the risk team's job when they're approving new collateral types is to sort of factor in this kind of an unknown. So there's going to be a comfortable buffer on each side of say a proposed debt ceiling that just factors in we don't know what could happen. So this is what the numbers tell us, and let's lower that by 20% just to be safe. Or is it specifically what the numbers say?
Oh, I'm just looking in the chat right now. I can actually combine that with, actually, do you want to shoot with your liquidity risk question? Because I think it might actually.
Yeah, sure. So I was just kind of wondering, like, obviously we talk a lot about, different markets, and we do talk a lot about liquidity risk, but different markets are just going to naturally have different liquidity levels, right? So for example, a tokenized, like A-rated commercial real estate property is, at first blush, it sounds like, okay, that's a great asset to have as a collateral type, but maybe relative to like a crypto's utility token, for example. But at the same time, markets for these tokenized real estate assets are, in the very nascent stages, and there's likely to just be very low liquidity for some time. So how do you kind of like balance that desire to bring on sort of traditional assets that have some kind of inherent value against this need for liquidity and being able to kind of interact with our smart contracts?
Yeah, that's actually the basis for when I first thought about debt ceilings. The first thing that came to mind for me was recourse. It's all about recourse. And what I insinuated at the beginning of this meeting was that recourse is essential, and for now, the recourse that we use is the secondary markets. So we rely on the liquidity of the secondary markets. We rely on it to be fully functioning, diversified in terms of breadth and depth, so that we can actually realize said value from collateral. But not all collateral actually will have that. In fact, there's quite a bit of the collateral types out there, that especially the ones that approach us, that do not have that trading profile that is conducive to be a collateral in the strictest sense of the word. So we need to have a look at a better way of finding recourse. You could find recourse off-chain. You have an inherent risk on that, but you can do that. As an example, let's look at gold-backed tokens. Essentially, the recourse there is getting onto a plane, going to the destination, and handing in your token and receiving gold back for it. That is the ultimate recourse in that matter. And that is mutually exclusive from what their trading profile looks like. A lot of folks look at gold futures and spot gold as some sort of mechanism to divine what the volatility should be and the ability to extract the requisite value from the collateral. But essentially, none of that is important. The only thing that is important is recourse. And what we're doing is looking at recourse from literally going to go and get that asset that belongs to you all the way through to the secondary market aspect to see what can be represented from that point of view. And obviously, the easiest right now is looking at the secondary market. The easiest right now is looking at price discovery and using the collateral types that fulfill that trading profile as best as possible. But it constrains us. It leaves a lot out. So we need to be a little bit more imaginative and a little bit more creative in terms of what recourse means, and make it very clear to folks that participate in the system how they can go about that process of actually liquidating and getting recourse. I hope that answered the question.
Yeah, thanks.
Is that going to be one of the criteria when we're evaluating things like REITs or other commodity-based tokens, that before we can approve them, we have to show that there's a liquidity solution available?
Oh, it's paramount. It is the defining factor, in fact. I mean, the very act of pledging collateral is literally the sole definition of recourse. You want to be able to lean back onto something that is pledged in order to satisfy the outstanding loan. And how you do that is through this process of saying, well, I am here with this asset in my hand. How do I go about turning it into another asset, being fiat or a more liquid asset? How do I go about doing that? The answer to that question will define if that can be included or not. We've had a lot of collateral types that suggest, oh no, include us, no, we're fine, but what's the recourse? If the recourse is maybe you'll get your money back, maybe you won't, well then obviously we can't do that. There might be some tokens, in fact there are some tokens out there that purport to be backed by I'm not going to give it away, but purport to be backed by certain assets, but they have in their fine print that maybe they will redeem, maybe they won't. And if that's the case, then it's clear that we clearly will not include them.
Yeah, of course, I guess that makes sense. I don't, maybe Ashley, you have some more insight than I do. Are real estate backed tokens, are they a reality yet or still like a distant dream, do you think?
They're very much a reality. There have already been several projects that have been tokenized, and there are some very, very large REITs with name brand buildings that you would know that are working on this problem actively. And all of the ones that I have spoken to have been very intrigued by the idea of using tokenization to access new markets and different kinds of liquidity, and also to interact with Maker's ecosystem and hopefully improve some of the interest rates that they're paying. But the issue that I keep running up against is how are we going to offload these assets? How are we going to evaluate them over time? I mean, most REITs are issuing like quarterly reporting on valuations and all of those things, but what about for smaller, more privatized? You have a lot of deals that are like special purpose vehicles where they're set up to go out and buy sort of one building. How do you evaluate those, and then what does the marketplace for those look like? And Maker's kind of in an interesting role with this because in some ways we're both a lender and a credit rating agency, right? But we also need to be able to identify and connect technologically with these markets where these assets can be sold off. And I know that Lev and the team has spent a lot of time building out a pretty ingenious auction mechanism to maximize value in the event of a liquidation, but all the same, there's still a lot of unanswered questions there.
Mm.
That's really interesting. You brought up something that I think is particularly fascinating. When you said credit rating agency, are you saying that we're sort of placing a stamp of approval as sort of one of the blue chip organizations in the space. So if we allow a collateral type into our ecosystem, we're actually, giving it a rating at that point.
I mean, Stephen can probably answer that better than I do, but from where I'm sitting, that's sort of what it looks like, right? We're assigning a credit rating to these companies, and we're assessing parameters around that, including the interest rate that they ought to be paying in the fair market, et cetera. So, it looks like a credit rating agency to me.
Yeah, I've had that thought myself that, being approved as a collateral type in the future could potentially, bump a token's value, and might have some, the act of accepting it might actually change the risk parameters that we've assigned it, because it's now more popular. Stephen, is that something that the risk teams have thought about?
Oh yeah, I mean, that actually is part and part. Actually, is an intersection of risk economics and business development. It's the very basis of it. There is a notion that obviously everyone knows. This gentleman George Soros brought out. It's called the sort of reflexive principle, or the sort of uncertainty of human beings, where you have to keep in mind that the very impact that you have will have a circular effect on the price as well. So including something will have an increase in price. People may even anticipate that and decide to buy beforehand. You may have strategies, investment and trading strategies based around these concepts. You might have, folks looking at approval mechanisms of certain collateral types being event-based ideas to invest in. So much can actually be formed around this. Have we taken that into consideration? Unfortunately, we cannot. But we are obviously going to be aware of it. To a certain extent, I think there's going to be a natural relationship between goods and services produced on the blockchain and the fact that by creating a credit facility, or at least creating an ability to draw out DAI using their assets, will allow them to bolster not only their own activity, but their own transactional value as well. So the whole thing has a self-perpetuating effect. Once they're approved, they'll get noticed, the value will improve, and so on and so forth, all the way up to a critical mass where it'll hit some sort of fundamental value of what that organization is. And thereafter, it's more dependent on who they are and what they do, more than what we provide to them from a transactional point of view.
Presumably, the organizations of such a size that would actually move the needle would probably not be radically impacted by the addition of an asset class in the CDP, I'm guessing. So OMG is large enough to already have its own ecosystem and its own economy working, that being added as an asset class would not, rapidly or radically alter their valuation. And
no,
but the smaller ones. Sorry,
it would. But one thing it would do, though, is that it would alter. It would alter the opportunity set given to its investors. That is essential. I mean, there's one thing to take possession of a token that gives you a sense of value now and in the future, but that is all it is. It becomes an asset when you can actually do something with it. And what the Maker, in my opinion, what the Maker system does is allows folks to turn their investments into broader sense of what an asset does, to give you opportunities and to give you flexibility in financing yourself for further purchases, for diversifying your portfolios you do to start off with. In fact, it's the very premise of traditional finance, in that you take an asset, and as soon as you have an asset and you attach rights to that asset, you've got a certain amount of prosperity that you can get from that asset. If you can just finance it appropriately to not only cover the costs of owning that asset, but being able to employ that asset to derive more revenue from it. It's fundamental.
Okay, I think I'm getting a clearer picture of what's going on here, so that's good. We have 8 minutes left. I think that we should probably tackle some more questions, or did you want to? Okay.
Yeah, more questions.
More questions. NK Pine, question number 2. So with respect to correlation risk, is the idea that the stability fee would be leveraged to incentivize the set/distribution of collateral types to optimize for the diversity benefit? I hope that makes sense to you, because it doesn't make sense to me. Does it?
No, I get it.
Okay, cool. Well, you can explain it to me then.
Sure.
All right. Should I finish the question, or is that enough to start with?
No, finish the question, because I think
he says that it seems complex and as a potential source of bias, as the correlation of a single collateral type relative to the basket will change as collateral types enter, exit, and scale within the system.
I think it's a marvelous question. It really is. It touches on a couple of things. The first being that there is this concept of looking at your correlation, your collateral portfolio like an investment portfolio. So consequently, what happens is that in your mind you've got this need to optimize and be efficient, and use that efficiency for your benefit. It's the very basis of investment management. As soon as you have a diversification benefit, use the diversification benefit to enhance your return profile. The reason that is done is because it is based on the sole objective of increasing your risk-adjusted return on capital. That is the sole aspect of an investment manager's point of view. A collateral portfolio has that in part, but not completely. So when we do create diversification benefits, we will not use them. In fact, we will try and manage that as best as possible to use it as extra capital buffer for the system. So instead of having a benefit and go, oh, we can add more assets and we can use that benefit that we've created, you don't. You leave it there because that's going to absorb risks that maybe you haven't planned for. It's going to absorb risks that are going to be unforeseen. It is an extra bit of protection that you have in hand. Further to that, and this is the interesting thing, is that extra buffer that you get from diversification benefit will allow you to create a general policy tool that we've discussed before, that is the stability fee, to look after the entire economy, and granular policy tool to decide which assets can actually be, which assets may be conducive to more potential supply of DAI. So in essence, yes, it is complicated. It's complicated if you're trying to constantly create this optimal environment where you are constantly maximizing your risk-adjusted return on capital. If that was the only objective and the final objective, then yes, this is an overcomplicated exercise. But we're not doing that. We are trying to keep the integrity of the system in check and make sure the stability of our coin is firmly looked after. And that means we need to ensure that the portfolio works in conjunction with that as the final objective. The risk-adjusted return, it is a component. It should be in there. It drives how best you create benefit for the underlying MKR token holders. But at the same time, it needs to create that stability.
I have a quick question just to follow on to that. Yep. How do you measure within the system how we're doing on that, right? Is it the stability of DAI? Is it the amount of outstanding? Is it the market cap of DAI? Is that how we know that we're doing a good job of keeping this, sort of as riskless as possible? What's the metric that you're looking at to know that we're doing well on managing risk over the whole portfolio?
There was actually, to answer your question, I'm going to just refer to, I think there was another spoke about, where was it? Wasn't there one, Rich, by T-Bone?
Yeah, at the end here, what is the basic risk disposition of the MRT? To ideally never have a maker dilution event and possibly leave some money on the table, or is it to incur? Is this the question you were thinking of, Steven?
Yeah, that's it. That's okay. It. Because yeah.
What is the basic risk disposition of the MRT to ideally never have a maker dilution event and possibly leave some money on the table, or is it to incur the occasional bailout, which would be offset by a higher maker burn rate?
So what that actually, that question talks to is, how do you go about assessing your situation? and this is really what Ashley is just pointing on right now. How do you know that you're doing well? How do you know that things are going to plan? There is a couple of elements to it. The first one is obviously your collateral portfolio as a whole needs to have a certain amount of stability in terms of its overall volatility. You know, most people would think that the collateral portfolio should have a stable value, but not necessarily. What you want is the value may change, it just should not change rapidly. That's the most important aspect. The other aspect is actually the mechanisms around the system. They need to be functioning fluidly. Your distribution of CDP users needs to be broad and you know, diversified. You need to have different incentives for actually creating CDPs. You need to have different incentives for using DAI. So you need to have a look at the distribution of your DAI holders as well. And we're in a place, we're in a space where you can actually measure these things. I mean, only to a certain extent. Obviously, one person can have many addresses, but you can use those addresses as somewhat of a proxy. At the same time, looking at the question that T-Bone asked, this is looking at the auctions. You want a firm and broad distribution of participants in that. And you can only have that if they see value in being part of that, which means that you can't be extraordinarily strict and decide that all liquidation ratios are going to be 300%. Because if that's the case, you're not going to induce any economic behavior that will drive profit incentives in the system. And the one part of that is the liquidation auction. You need to have that fluid as well. So CDPs being liquidated is not a bad thing. Being able to have that working fluidly and continuously is as important as anything else, because that's where you get the true realization of value. So to answer Ashley's question, my metric would be not just the growth in the supply of DAI, which is obviously the most important, but the low volatility in the collateral portfolio, and also the fluid realization of value through the liquidation process. Those three aspects would be incredibly important, because without them, you don't have the ability to relate your incentive to an actual outcome.
Wow, you just blew my mind a bit. I hadn't considered that. All right, I'm gonna have to think about that. We're at 10 o'clock, so we're at least locally, so it's been an hour. Thanks for all the amazing questions, Ashley. Those were genius. Thanks, T-Bone and NK Pine, for keeping us on our toes with our questions in Reddit. I think we're going to put a fork in this meeting. Thanks, everybody, for showing up. Thanks, Stephen. That was amazing.
Much appreciated, folks. Thank you very much.
Thanks, Stephen. Learned a lot.
All right, bye, everyone.
Thanks, Jordan.